I think the role of speculators is a fairly clear one, which is that they are essentially the counterparties for physical players within the market who are looking to hedge price risk for either production or major purchases of energy. So in that sense, they are performing a very necessary role within the market, in the commodity markets and oil in particular. They're also bringing a degree of liquidity and price discovery to the market. And they are also, all other things being equal, tending to reduce transaction costs for those same physical players who are trying to hedge risks within the market. So I think the sort of popular view that speculation per se is a bad thing is misguided. I think we can look at individual trades or individual traders or speculators and clearly if there is any malpractice going on, if there is any attempt to manipulate the market, then it is the job of the regulator to ensure that those speculators are controlled. But the idea somehow that we need to get rid of speculation from the market, I think is actually quite a damaging, or potentially damaging issue, because if you reduce liquidity in derivatives markets, the danger is you're going to get more price volatility and not less price volatility. And I think consumers and producers and investors for the long term in energy are looking to try and limit, to the extent that you can, volatility within the market. Commodities are inherently volatile. They always will be, they always have been. But of course we'd prefer that volatility did not get out of hand. But I think that is a real risk. The risk is that regulatory moves which actually end up inadvertently suppressing liquidity in the market risk adding to volatility and not cutting it. In terms of the impact on fundamentals, daily supply-demand fundamentals, I mean the key feedback from the futures market, or the key interaction, is via inventory, cash and carry, arbitrage opportunities and inventory, and therefore it's the price signals that market participants get from the futures curve to either build storage or reduce storage. So there is an interaction clearly that is coming from the perceptions of futures market players. Otherwise, I think it's rather difficult to identify clear impacts, let's say, on supply or in demand. And one thing I think we need to bear in mind is, again, going back to the perception that speculation is inflating prices somehow. Now, if that were the case over a protracted period of time, you would tend to see an accumulation of inventory. And I think it's quite interesting when we look at global supply-demand balances, which is what we do every month at the IEA, there really isn't evidence that in the run-up in prices that we saw 2005, 6, 7, 8, and so on, from the data that we have, there really isn't an indication that there was an accumulation, globally speaking, of inventory. And therefore the perception that speculators were distorting the market, I think it's difficult to prove. Now, of course, we lack data. We lack data on the physical side of the market, and we lack data on participation in the less visible parts of the derivatives markets, the over-the-counter markets. So it's very difficult to be definitive, but with the data we have available at present, it doesn't look like there's a distorting effect that is coming from speculative players within the market. But of course, research continues. When you're looking at oil demand, the primary driver is income. And obviously with the financial crisis and the collapse in GDP in the second half of 2008 and early 2009, we had a contraction worldwide in demand, not only in the developed economies but also in the developing economies. So directionally speaking, we wouldn't be surprised that there was a collapse in prices at that time. A lot of people look at the subsequent rise in prices, even during a period when there has been intense economic uncertainty, and say, how can this be justified by market fundamentals? I think our view at the IEA would be that it is, at least directionally, the strengthening of prices that we've seen since early 2009 has been justified by market fundamentals. Because since the middle of 2009, in every single quarter, and at a fairly rapid pace since mid-2010, global implied inventories have been tightening, which is to say that demand has been running ahead of supply, and then therefore inventory has fallen. So the fact that prices have risen is not in itself a surprise. Now, would or should prices have risen to $110 per barrel or $95 a barrel? Frankly, I don't have the answer to that. The second part of your question, is this a price that many people can live with? I think producers, yes, are probably quite happy with prices at these historically elevated levels. For the long term, we're likely headed towards more expensive oil. The marginal cost is increasing as our ability to expand the supply base, or it becomes more difficult to expand the supply base. I think the problem is where we are in the economic cycle, and we really have to ask ourselves if triple-digit oil is beneficial to the global economy at this point in the economic cycle. Consumers are spending 5% of global GDP on oil at the present time. The last time that happened was in 2008, when the economic crisis occurred, and the two previous occasions when consumers were spending 5% of global GDP on oil, we also saw either a very marked economic slowdown or outright recession. So I think there are concerns, certainly from consumer and importing governments, that these level of prices are already damaging economic activity on a global basis. It's not the only factor, but it's contributing. So it's a question of timing. For the long term, we may well be headed towards higher prices because of resource constraints on getting at the resource base. But in the short term, I think we've got concerns about this level of prices and what it's doing to the economy. I think the premise of your question is almost that speculation is a primary factor in having driven prices back to $110 per barrel. As you know, I probably take issue with that premise. So it's difficult to say. I mean, I think there are clear reasons why prices have increased sharply, and they're more to do with market fundamentals over time. Probably financial flows have amplified some of the existing shifts in prices. I'd go back to my previous answer, which is the danger is, I think, for producers and consumers, if we have prices remaining at these very high levels when the global economy is in a very fragile state, the risk is that it's the straw that breaks the camel's back and tips us back into recession again. It may not be the primary cause of the economic slowdown, but it surely is something which exacerbates balance of payment problems, debt problems, and so on. And I think producers and consumers would lose if we tip back into another global recession. Time will tell.